Namaste. Welcome to our channel. Today I am discussing about the FDI investment in startups itself. What is an FDI? It's a foreign direct investment itself. And startup. Startup is, as you know, it's a new company which is startup in India. FDI investment in startup I am discussing in purview of the FEMA Act itself. A startup as defined in the FEMA Act is it should be a private limited company itself. Company which is a private limited company can only become a startup as per the FEMA Act itself. As per the notification GSR 127(9) of the FEMA Act itself. As per the conditions, whatever may be said in that notification, startups will be defined itself. The startup should be a private limited company and it should be as per the notification. Startups is recognized by, or what is it, it's approved by the Department of Promotion of Industrial and Internal Trade Department. It's a department of the Government of India, shortly called DPIIT. It's a main department which is making the policy of the foreign direct investments in India itself. Foreign direct investment policy is right now from 15/9/2010. It's made out by the Government of India, taken over from the Reserve Bank of India. Even though that is the thing, the Reserve Bank of India is the administrative control of the FDI policies. They itself make the policies and the Government of India approve them itself only. So a startup should be recognized by the DPIIT. In short, what is the startup said in the FEMA Act itself? It should be a private limited company itself. It should not exceed, from the incorporation, it should not gone more than 10 years itself. So before the 10 years, up to the 10 years itself, a private limited company will be called as a startup itself. After 10 years, it has become matured and it will be gone out from the startup category itself. Then its turnover. The turnover of the startup company which is we are starting should not exceed 100 crore itself. So up to 100 crore, it will be defined as the startup itself. Also, the startup should be for the production of a product or a service which is innovative itself, or it is something which is a new thing itself, and a project in that way that it should become a financially wealthy company in the future itself. So these four clauses are the things which should be remained when we are just going to register a company as a startup under the DPIIT in FEMA Act itself. That should be a private limited company. It should not go over more than 10 years itself. Turnover should not exceed more than 100 crores itself. It should produce a product or a service which is innovative and which is a new one to the society or the industry itself. And the project should be very wealthy, should make the company a wealthy and a very financially status company itself. In short, what is called a startup in the company, and it is recognized by the DPIIT. All the formalities regarding the startup can be seen in the link or in the site called www.startup.gov.in. Anybody is wishing to just getting into a startup can just go to this site itself. My intention to this video is that whether a startup in India can get foreign direct investment from a person resident outside India or from an entity outside India itself. The answer is that it is yes. The startup can raise the money from outside India, from a NRI or a resident person outside India, or from a resident entity outside India also. How could a startup can raise the money itself? It can be based through 3 or 4 mode of payment itself. That is, one is it can be issue equity instruments to the person outside India or the entity outside India. It can make convertible or fully paid or mandatorily convertible debentures to the person outside India or the entity, or it can issue convertible preference shares or the mandatory preference shares or the fully paid preference shares outside India. So these 3 instruments can be given by a startup to a person resident outside India for making the funding itself. The other way of the investing startups is called the convertible notes itself. So what is a convertible note? A convertible note is a thing that a startup can raise the funds from a person outside India by way of a debt. They can raise the money of a debt on the condition that the debt will be repaid after a certain period of the time itself. The period should not exceed 10 years. So within the 10 years, that amount which is raised from outside India or the Indian entity or whatever thing, startup has to repay that thing. Or this debt can be converted to equity shares by the startup itself, so that person investing in that startup will become the equity shareholders of that company itself. So startups can raise the funds through the convertible notes also. Convertible note, what I said right now itself. What are the conditions that for a convertible notes itself? I just said in some of the previous videos that person can raise the money from outside India through 2 routes itself. One is that automatic route and through government approval route itself. If it is just making through an automatic route itself, startup can raise a convertible note up to rupees 25 lakhs. So up to 25 lakhs, a startup can raise money from outside India through convertible note from an entity outside India or whatever may the thing, from a non-resident person, you just can raise the person in India. If startup is in a sector. Sector means area where approval is required or a certain percentage is to be only can be invested, etc. There are government regulations for that. If it is in defense, it should be made up to a certain limit itself. If it is in atomic energy, it's not permitted, etc. That is a government policy itself. If it is a government approval route itself, then startup has to follow all the government approval policies. That is a sector policy. If the equity shares, is valuation should be there. If it is made through a listed stock exchange, it should be through the merchant banker. If it is not unlisted shares, the valuation of the shares should be done, or the pricing of the shares should be done by the valuation of a chartered accountant or a merchant banker. Then if it is a transfer of shares, it should be as per the regulations of the RBI itself. So the startup should have to comply with the sector policy, the pricing policy, etc. if it is going through a government route itself. Then a convertible note can also be made by the transfer of shares. If an existing startup company who is just working now, they want the shortage of the working capital, they can just transfer the shares to a person resident outside India. So in that case, the transfer of shares rules, etc. that's made by the Reserve Bank of India or whatever the transfer of shares, etc. should be out to be followed by the startup itself. Then also an NRI and OCI person can invest in startup on non-repatriation basis. That is, NRI can invest in that startup if he's not intending to return back the money towards outside India. So in these three ways itself, startups can invest in India itself. If it is through the government approval route, should be made all the policies and compliance of the government approval routes, then regarding the pricing policy, etc. If it is to transfer shares, it should have follow the transfer shares rules. An NRI or OCI can invest on non-repatriation basis, and if it is a normal startup investment through a convertible note, it can be made up to 25 lakhs. Startups can raise the funds through equity investments, convertible preference shares, convertible debentures, and through the convertible notes also. These the four ways startups can raise the funds in India from outside India itself. Raising of the funds from outside India should be through the normal banking channels or through a foreign currency account by the startup itself. They should have to raise the funds through the banking channels itself. The person who is just investing in the startup should be through the banking channels, or should be through the debit of a NRI or FCNR account itself. If the startup is just returning back some money to them after the proceeds or something like that itself, then also the proceeds returning or repatriation should also be through the banking channels or through the credit of the NRI persons, NRI account or the FCNRB accounts. So receipt and the payment of the fund through the startup should be made through the banking channels itself. That is another condition of the startup investment in India. The reporting, if an investment is made in the startup channel, it should be reported to the RBI through the authorized dealer in form number CN30. It should be done. It should be done through an authorized dealer. It can be done by the startup company or the person who is investing the company. That reporting also is very mandatory for this thing. Thank you for watching my video. Subscribe my videos, share my videos as much as possible. Press the bell icon to see the future notifications, etc. Watch my future videos and wait for my videos itself. Give me as much as possible likes itself also. This is Radish signing off. Thank you.